So now we're going to get into really calculating and journalizing these bonds payable transactions and the interest expense. So again, you're going to want to make sure you have a calculator handy and have your notes printed out with you so we can walk through these example problems. So the way bonds work is we talked about bonds are issued on a market. The stock market works similarly, and we'll talk about this a little bit more in chapter 13. So the first time we put the bonds up on the market, this is called what we call the primary market. So we're going to put the bonds up on the market, and investors are going to buy the bonds. The first time the first investor buys the bond or buys one of the bonds, we, the company, get that money. We'll get their $1,000 or a little less if it's a discount or a little more if it's a premium, but we'll get their money. Then once they've bought the bond, they can choose to hold that bond for the entire 5 years. They can choose to hold it for 1 year. They can choose to hold it for 2 years or however long. And then they can put it back up for sale on the market. That is called the secondary market. You can think of it as they're selling a used bond, so to speak. So anybody can go now and buy that used bond. When that happens, we, the company, don't get any money for that. We just get a notice that says, hey, Joe sold his bond to Sally, so you should start sending the interest check to Sally now. But we don't get any money from that transaction. We only get money from that initial transaction when we sell the new bond. We don't get any money when the used bond is resold on the market. So here we are, Smart Touch Learning. We have those 100,000 of 9% bonds. So that really means there's $100,000 bonds, but we're talking about them collectively. So there's $100,000 bonds that make the total of 100,000. They mature in 5 years. These bonds are issued on at face value. So what we know about this, and you want to jot this in your notes, is that we know that the market rate is equal to 9%. We know that the investors looked at that and they said 9% is exactly perfect. I'm willing to pay $1,000. So the market rate is exactly equal to the stated rate of 9%. So in this instance, we are getting exactly $100,000 and we're going to have to pay back $100,000 at maturity. So our journal entry will be to debit cash, credit bonds payable for $100,000. Now, in real life, how often do bonds actually sell at face value? Not very often, right? So this is one of those kind of classroom only scenarios. Very rarely does that happen in real life, but we'll walk through this scenario first before we get to the discounts and premiums. So we issued the bonds on January 1st of 2024. We know that in 6 months we have to make our first interest payment. So on June 30th and December 31st of every year for 5 years, we're going to make our interest payment. Now, we've already done our interest calculation. Remember, we did it earlier. So we said that interest is equal to principal times rate times time. In this case, the principal is 100,000. The interest rate is 9%, and the time is 6/12. So that's $4,500. So every 6 months, we're going to write a check for $4,500 and mail it to the bondholders. So we will credit cash for $4,500 and we'll debit interest expense for $4,500. We're going to do this 10 times over the next 5 years. So I want to point something out. At the end of 5 years, we will have paid out $45,000 in interest. Okay, because over the next 5 years, we're going to pay interest twice a year for 5 years, so that's 10 times at $4,500. We'll have paid $45,000 in interest. So it cost us $45,000 to borrow $100,000. Okay. That's the power of compound interest. All right. So now we're looking at a different scenario. So here we're told we've got 100,000 9% 5-year bonds pay interest semi-annually, but the bonds sell at 96.149. Okay. What this means is the way this reads, the bond selling price is at 96.149% of face value. Now, here's the thing. They are never going to put the percent sign on it. This goes all the way back to the time of newspapers when used to, I mean, now you look it up on the internet, right? But used to, the bond prices were printed in the newspaper every day. And so if you wanted to invest in bonds, you got your newspaper every day, you went to the financial section and you looked up the bond selling price. They didn't put the percent sign on it because that was an extra character, and for a newspaper you have to pay by the character. So everybody had to know that was a percent. So what we know, because this bond is selling at less than 100, less than 100% of face value, this bond is selling at a discount. Okay. We do not know what the market rate of interest is, but we can make some inferences. So since this bond is selling at a discount, we can infer that the market rate of interest is greater than 9%. In other words, the investors looked at our bond and they said 9% interest, that's not enough. Okay, so the investors are demanding more than 9% interest. I can't pay them more than 9% interest, so instead I sell the bond at less than face value. Now, this means that I'm going to receive less than $100,000 cash, but at maturity, I still have to pay them $100,000. And I still have to pay them interest based on $100,000. But I'm going to get less than $100,000 up front. In fact, I'm going to receive, if the selling price is 96.149%, that means I can calculate the selling price by converting that to a decimal. So 0.96149 multiplied by 100,000, I'm going to receive $96,149. So when I do my journal entry, I'm going to debit cash for $96,149. These are the bond proceeds, is what we call this, but you can think of it as this is the cash that I receive. So I'm going to debit cash for $96,149, but I'm going to credit bonds payable for $100,000 because that's how much I have to pay back at maturity. So the difference is a debit to an account called discount on bonds payable. This is the amount you can think of as this is the amount that I gave up in order to be able to sell this bond because I need money, and so $96,000 is better than zero. I'll give up $3,800 in order to be able to borrow $9,600. So discounts on bonds payable is a contra liability account. So remember, liabilities have a normal credit balance. Therefore, the contra liability will have a normal debit balance. So when we look at the accounts here, bonds payable is the main account. It has a credit balance of $100,000. The discount has a debit balance because it's the contra, it's the opposite. So on the balance sheet, just like we did in Chapter 9 with accumulated depreciation, we're going to list the bonds at $100,000 and then we're going to subtract the contra liability. This is what we call the carrying value, or you'll also hear it called the book value. At issuance, the carrying value is exactly equal to the proceeds of the bond. It's exactly equal to the selling price. Now, so let me give you a chance to fill in your notes there. Discounts on bonds payable is a contra liability. It has a normal debit balance. The bond payable minus the discount gives us the carrying value, or again, you'll sometimes hear it called the book value. Okay, so that 38.51, that amount that I had to give up in order to borrow the money, that discount, that's actually will be a form of interest expense. But interest expense, remember, is the cost of borrowing. Any cost that I incur to borrow the money is interest expense. So in order to borrow this money, it's going to cost me the $45,000 of interest payments, plus it's going to cost me the $38.51 that I have to give up in order to get this money. So that's going to become that's going to become interest expense. Now, we said on the previous slide that we couldn't determine what the actual market rate was, and I won't ask you to determine that. We just said that we know that it's more than 9%. Here we're being told that it's 10%, which great, fine. It's more than 9%. That's all I expect you to know. Now, what we're going to do is, remember that contra liability has that debit balance in it. What I want to do is get that debit balance to be 0. Because what I want is, by maturity, I want the carrying value of the bond to be the exactly 100,000, which is the amount that I have to pay back. So slowly, I'm going to have to amortize the discount to make it go from 38.51 debit to 0, which is going to make my balance sheet go from 96,149 carrying value to 100,000, so that when I pay back the bond at maturity, the discount is 0 and the carrying value is exactly the amount that I have to pay back. So that process of making the discount go from 38.51 to 0 is what we call amortization. There's different methods that you can use. We're going to do what's called straight line amortization. It's the easiest. So remember, we're paying interest every 6 months for 5 years. So in other words, we're paying interest 10 times. So straight line amortization just says I'm going to take the 38.51, the total amount of the debit, of the discount here, and I'm going to divide it by 10 time periods. So if I pay interest 10 times, then 38.51 divided by 10 interest payments means every time I pay interest, I'm going to credit the discount by 385. And actually, we're rounding to the nearest whole number here. On the last one, we'll do it for 386. So if I can draw my discount T account up here, it has a debit balance of 38.51. Every time I pay interest, I'm going to credit the discount for 385. After I've done that 10 times, the discount will have a debit balance of 0. Okay. So let's look at our journal entry here. Now, we've already explained that we are going to credit cash for $4,500. Notice that just because I issued the bonds at a discount, that did not change how much I have to pay for interest. Interest is calculated based on the 100,000 face value, not the selling price. So I still have to credit cash for $4,500. We've just said we're going to credit the discount to reduce it by 385. I know I have to debit interest expense, so my debit to interest expense is going to be for the total of what I have to pay plus the discount that I'm amortizing. So since debits have to equal credits, the interest expense is the $48.85. It's the total of the two. Now, I'll warn you, a big mistake students make is we want to change the cash amount. The $4,500 is the amount of cash that we're paying. That does not change. So we're going to make this exact same entry 10 times. By the time that we've made it 10 times, the discount will be 0. The cash amount I will have paid out, we said, was $4,500. So in that case, the total amount of interest expense, will be $48,851. You could have calculated that one of two ways. We could have said the interest expense of 48,485 times 10, or we could have said the total interest of 45,000 plus the discount of 3851 is how we're going to get the 48,851. So in this case, it would have cost us $48,851 to borrow 100,000. Remember, interest expense is also called the cost of borrowing. So sometimes you'll see it totaled or termed that way. What is the cost of borrowing? It's 48,851. So that if we issue the bonds at a discount, the discount increases the interest expense. So again, here's just looking at the T accounts after the first two entries. So we can see that slowly that discount is getting smaller and smaller, which if we were to look at the balance sheet, the carrying value would be getting larger and larger. So here we see the carrying value is now not 96 that we saw earlier, it's now 96,919. So it's slowly going to get larger and larger and larger so that at maturity, the discount will be zero and the carrying value will be 100,000. So this amortization schedule shows us that for every payment that we make, we're going to pay $4,500. These are just done by years. Or by every 2 months, we're going to have interest expense of 48,851 and the total discount is 3851. So the total interest expense is the interest payment, the cash paid, plus the discount. Now, if we issue the bond at a premium, what this means is we're receiving more than $100,000 for our $100,000 bond. So instead of using discount on bonds payable account, we'll use an account called a premium on bonds payable. The premium on bonds payable account is what we call an adjunct account. An adjunct account has the same normal balance. So in this case, premium on bonds payable will have a normal credit balance. And on the balance sheet, it will increase the bonds payable, not decrease it. So here we're told that we're issuing our 100,000 9% 5-year semi-annual bonds at 104.1. So what this means is our bonds are selling at 104.1% of face value. So the cash that we're going to receive would be, convert the percent to a decimal, 1.0410 times 100,000. So it means our bond proceeds are 104,100. So when we do our journal entry, we'll debit cash for 104,100. We'll still credit bonds payable for 100,000, and then we'll credit that adjunct account for the premium of 4,100. So again, the adjunct account is increasing the carrying value. So on the balance sheet, we're going to add the adjunct account. So the premium is, the carrying value is more than the principal, more than the face value of the bond. Now, just like we amortize the discount, we're going to amortize the premium in the same manner. So to amortize the premium of $4,100 over a 10-year period, or excuse me, over 10 payments, twice a year for 5 years, we're going to say 4,100 divided by 10 interest payments. Means that every time we pay interest, we're going to amortize the premium by $410. So remember, the premium has a normal credit balance. It's sitting here with a credit of 4,100. So that every time I pay interest, I want to now debit the premium for 410. So after I do that for 10 times, suddenly my premium will be zero. So we know that when we pay interest, we have to pay cash of $4,500. So I'm going to credit cash for $4,500. That never changes. Now I'm going to debit the premium for $410. So my debit to interest expense is now for only $4,090. It's for less. You can think of the premium as kind of being a bonus. It reduces my interest expense. The actual cost of borrowing now will be less because I got this bonus. I got this premium that I do not have to pay back. That $4,100 is never paid back to the bondholders. I just get to keep it. So I'm going to credit cash for my $4,500, debit the premium to reduce it, and then debit the interest expense for the difference. So again, I can see now that my balance sheet is getting, the carrying value is getting smaller and smaller, so that eventually after 10 times of doing this, after 5 years, it will be 100,000. The premium will be zero. The carrying value will be 100,000, which is exactly the amount that I have to pay back. And if I look at the amortization table, notice now that the total interest expense for the premium is only 40,900. So in this case, it cost me 40,900 to borrow as opposed to 45,000 or 48,851. It cost me less because I got that premium up front. Now, I know that these are complicated and I know that these problems can get confusing. So again, you're going to practice these in your homework. I really encourage you to practice by writing down all the steps and then working through the problems and inputting it in my accounting lab to check your answer.